Hello, my name is Eddie Topic. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. There has been a pattern in operation that I have highlighted here since last summer. I had pointed out this cat's ears pattern over June and July 2023. In essence, it's a double top formed in an overall downward moving market. The potential below for such a cat's ears pattern is target X2 in the 502 zone. But for now, I will retire this target after this commentary, as it currently seems no longer viable with the move higher we have seen these past few weeks. It seems after all that where I feared this pattern might come unstuck at the 38.2% absolute Fibonacci line at 521 back in March, well, that's exactly where it did come unstuck. Likewise, and for similar reasons, I have also retired already the March 2022 to date broken downtrend, and I'll retire after this commentary the broken late December 2023 to late January 2024 bearish shift pitchfork, as well as the late January to early April bearish Andrews and bearish shift pitchforks. They are no longer valid. What we have seen is the rise of the market up through all these, as well as the short medium moving average currently at 571, the medium moving average currently at 590, the March 2021 low at 592, and the combination of the July 2021 high at 609 and the declining long moving average currently at 604. This was also up through some considerable congestion between September and November last year, and again in mid-January to mid-February this year, between those two moving averages. The market now has on top little in the way until the double stroke triple top seen back in December last year. But that's not the real resistance, not really. You see, the double stroke triple top back then was caused by the bright red highlighted, very slowly rising neckline extension to the small October to November 2020 head and shoulders top, currently at 664. And it is this that you should pay special attention to on the top side. Interestingly, this resistance is now backed up somewhat by the 50% Fibonacci line of the July 2023 to March 2024 move at 660. Okay, so what has caused this recent move higher? Well, it was the creation of a reverse head and shoulders bottom formed over mid-February to late April. The neckline is highlighted in dark blue, currently at 585 on my daily chart. This is not enough integrity in this pattern to allow some potential, there is enough integrity in this pattern to allow some potential targets for its topside. Thus, yeah, primary target X would be in the area which isn't that far away from recent highs. We also have and that's up at 935. We also have a secondary hard to reach target X1, in 635. We also have a harder to reach target X1 in the 655 area. Both of these would seem to be doable, but as they are both under the bright red neckline extension, though target X1 is above the previous double stroke triple top, which makes it that much harder to reach, they are still possible because of that move below, or their location below the bright red trend line. Chicago corn. The medium moving average, currently at 452 and highlighted in mauve on my daily chart, have been an effective cap on this market throughout 2023, most recently in October, November, and then December 2023. It has for the last 7 weeks also acted once again as a cap on any rises until yesterday, and I will speak more on this shortly. Now, going back a bit, back to mid-February, the prices had punched down back then, reaching the primary target 424 for the July 2023 to January 2024 descending triangle, which is still highlighted in bright red on my daily chart. Well, just about see it's way over there on the side of it. Please note the extension to the lower trend line, currently at 468, as this will become important later on. In the process, the market also punched down through the important 50% absolute Fibonacci line at 425. However, this piercing move low was too much for the market to swallow, especially in one go, even though it also breached, though did not break, the next support below, which is the December 2020 low at 414. It is from there that we saw a strong recovery, initially in a small bull channel, then a sideways movement between the mauve overhead medium moving average and the resistance turned support provided by the pierced bright green highlighted short medium moving average, currently at 442. So I said 2 weeks ago, and I quote, "I'm still minded to think that despite the attempted V bottom in late February and the subsequent failed small bull channel, it still looks like the ammunition below was and is not enough to, as yet, at least, though we have tended to see a more sideways move over the last 3 weeks than any reinvigorated move lower," end of quote. Well, we have seen over the last 2 days and an attempt higher. That seriously puts in doubt my thoughts there not being enough ammunition for the upside. However, I'm conservative in my nature, especially on any sharp moves, and I still hold with this idea for now at least. It is true that we have seen a strong break higher over the mauve medium moving average, but the market has seemingly stalled at the next obstacle overhead, the bright red lower trend line extension. That is not all, as just above that and coming into the frame is the gold highlighted long moving average, currently at 473. Now, I do think there has been a basing action of some form. The answer to that is yes. But I do think the market has enough ammunition to try higher as yet. Well, the answer there is no, but it is close. Very close. The immediate need in any try higher is to overcome the combined red trendline extension and gold long moving average. After this, there is a free area overhead until we come to the same old congestion band between 490 and 498 we saw so much of in the middle of last year. Now, all this move higher and potential even higher moves comes at a price, and the market has to be ready to pay for it. 4 weeks ago, I said the following, repeated since, and I quote, "Just be mindful of target X1 below at 374. This is the secondary and much harder to reach target for the descending triangle," end of quote. That will be the price for any move higher, the foregoing of target X1 below for the same descending triangle that we are challenging the lower trend line extension right now. Kansas City wheat. After a fairly narrow range, things are starting to happen here. Last time we still had the age-old pattern, one I highlighted 24 weeks ago, of a descending expanding wedge pattern that is now off the bottom of my daily chart. It's not the best example of such a pattern, but it still seemed valid in March this year, during its lifetime. And I'd also seen it, during its lifetime, I'd actually seen it develop with 2 other patterns, one of which involves a descending expanding wedge pattern itself. So back in early December last year, we had an attempted move higher, but it ran into the combination of the upper trend line of the descending wedge pattern and the green highlighted declining short medium moving average, currently at 587. Indeed, for a while, this pair of dynamic resistances held prices down. However, at the start of 2024, they started to separate, and in late January this year, we saw the market head lower. This developed into a descending triangle from late November 2023 to mid-February 2024, highlighted in purple on my daily chart. 12 weeks ago, we had an attempted breakout below, but prices hesitated, then continues to hesitate, such that what I initially thought might be a triple or quad bottom is now a quintuple bottom and turning into a rectangle pattern. Early last week, we saw the first significant breakout of this rectangle pattern on the upside, piercing and then closing over the descending medium moving average, currently at 603, which had run in parallel and just above the upper trend line, and then more recently with the purple highlighted lower trend line, currently at 586. The move higher accelerated over the 38.2% Fibonacci line of the big old 2011 to 2019 move at 618, as well as a January 2015 high at 646. But late last week and this week, it had been struck down by the next and last overhead moving average, and that's the long moving average, currently 656, which is now capping the market and coloured in gold on my highlighted in gold on my daily chart. Above this is a fairly free area, bar the December 2023 high at 677, all the way up to some significant resistances between 691 to 707, formed from the 50% Fibonacci line of the 2011 to 2019 move at 691, the 50% absolute Fibonacci line at 697, and a December 2014 high at 707. Do I think prices can make it this high soon? It is a reasonable point of view, especially if you look at the last few weeks' action as a potential bullish halfway hesitation, as it will lead prices right there as a target area. And the long moving average on its own would not necessarily be enough to hold down prices, especially with the ammunition gathered in the rectangle below and earlier this year. However, it's not a done deal, not yet, but it would extinguish one thing. 4 weeks ago I laid out some ideas below for a break lower from the descending triangle. Thus, the primary target X would be in the 539 zone, with a secondary harder to reach target X1 down in the 487 zone. These targets will have to be retired on any further attempts higher. I said back then, 4 weeks ago, I don't like what the continuing sideways movement may have as an effect on the break below the descending triangle, but I'll keep those targets below active for now. End of quote. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.